NVIDIA's revenue didn't just grow, it erupted by 114% to over $130 billion last year. But now, a new tech Cold War threatens to slice $20 billion off its sales. Is this AI superstock still a buy? Or are we looking at a boom and bust? Welcome to Deep Due Diligence. Today, we're unpacking NVIDIA, the chip powerhouse at the center of the AI revolution. In this video, we'll dissect NVIDIA's bull and bear cases, sift through its latest financials, model its valuation, and highlight key catalysts on the horizon. Whether you're a long-term investor or a trader, this deep dive will equip you with insights straight from the SEC filings and real-world data, all in plain English. By the end, you'll have our price target range for NVIDIA and a clear view of both upside and downside scenarios. Cue the CUDA cores. We're about to overclock the facts. Analysis starts now. Let's set the stage. NVIDIA is absolutely crushing it. In their latest quarter, Q1 FY 2026, they raked in $44 billion of revenue, a year-on-year jump of 69%. The engine behind that growth: data center AI chips. In fact, NVIDIA's data center sales hit a record $39 billion just last quarter. That's 90% of the AI GPU market by some estimates. They can't make these GPUs fast enough. Demand from the likes of Google, Microsoft, OpenAI, everyone is off the charts. CEO Jensen Huang said, "Demand for Blackwell is amazing," referring to their new AI chip, and that this AI boom is like nothing he's seen. But, plot twist, while NVIDIA's riding this AI wave, Geopolitics just threw a curveball. In April 2025, the U.S. government, under the newly re-elected Trump administration, dropped the Liberation Day tariff package. Think of it as tariffs on steroids. It slapped a baseline 10% tariff on most imports, but singled out China with punishing rates. Chinese tech goods now face effective tariffs reportedly as high as 125%. On top of that, the US is tightening export bans on high-end chips. NVIDIA already couldn't sell its best A100 and H100 GPUs to China, so they made a toned-down H20 chip. And guess what? That got banned too. The US told NVIDIA in April, no H20s to China, period. NVIDIA is now taking a $5.5 billion write-off because of this. Ouch. Morningstar even said it's pretty much game over for NVIDIA in China. That's the bear's big worry. Losing China, which was approximately 10% of sales and broader trade tensions. So, NVIDIA's at a crossroads. Insane AI-driven growth on one hand, new political roadblocks on the other. Next, let's dig into the bull case. The three reasons NVIDIA could keep winning despite these challenges. Pillar 1, insatiable demand. 2023 to 2025 will go down as the AI gold rush, and NVIDIA sells the shovels. Their GPUs are the default choice for training AI models. We're talking 90% plus market share in AI accelerators. Every big cloud, Amazon, Google, Microsoft, is scrambling to build AI supercomputers, and they're buying NVIDIA by the truckload. NVIDIA's data center revenue more than doubled, plus 142% in the past year. And guess what? It's still accelerating. They guided 65% year-over-year growth for this quarter, which shocked analysts. That suggests there's enough demand outside China to more than make up for the loss of China. Why is demand so crazy? Because AI isn't a fad for these companies. It's the future of search, of cloud services, of everything, so they must invest or get left behind. This is like an arms race. Even if the economy wobbles, no one's cutting their AI budget. One example, the $500 billion Stargate project, a massive coalition, SoftBank, Oracle, etc., building AI data centers in the US. They plan to use something like 64,000 NVIDIA GPUs by 2026. For NVIDIA, that alone could be approximately $4 billion in sales. And that's just phase one. These are mega orders. The bull case says we're still in early innings of AI adoption. Training one cutting-edge model can use thousands of GPUs for weeks, and companies will retrain models, build new ones, deploy more. It's a repeating cycle. NVIDIA also keeps raising the bar with new chips, like the just-launched Blackwell GPU, which had an $11 billion revenue ramp in its first quarter on the market, the fastest in NVIDIA's history. So, pillar number 1, the AI data center boom is real, and NVIDIA is the chief arms dealer. Pillar 2, NVIDIA's Moat, its software and ecosystem. NVIDIA isn't just a chip maker, it's a platform. Their secret sauce is CUDA, a developer platform and programming model that's been around for over a decade. It's basically how you tell NVIDIA GPUs what to do. Millions of developers have trained on CUDA. There are tons of optimized AI libraries, for example, CUDNN for deep learning, that work only, or best, on NVIDIA. This is a huge advantage. Why? If a competitor, say AMD, comes along with a new GPU, it's not enough to match hardware specs. Developers would have to port their code, re-optimize, and they might run into issues because the NVIDIA software stack is so mature. Many won't bother switching unless there's a big benefit. It's like being fluent in one language. NVIDIA's made itself the native tongue of AI computing. Prior to the export ban, NVIDIA had a 90% share in China's AI chip market despite Chinese alternatives, partly due to this software lock-in. Even now, with open source frameworks, NVIDIA keeps innovating on top. They offer AI enterprise software suites, model blueprints, and they just rolled out DGX Cloud with major cloud partners, which basically rents you NVIDIA supercomputers online. All this further entrenches their position. A great stat, over 75% of the world's top supercomputers run on NVIDIA. These researchers are coding with NVIDIA tools, which tends to perpetuate use of NVIDIA. So bulls say the CUDA moat will keep competitors at bay. Even if someone makes a chip as good as NVIDIA's, they're fighting an uphill battle against an entire ecosystem. That's why NVIDIA can charge premium prices and maintain approximately 70% gross margins. They're selling solutions, not just silicon. It's a bit like Apple's ecosystem. Once you're in, switching is painful. Pillar 3, NVIDIA's expansion and optionality. NVIDIA isn't sitting still. It's aiming to capture an even bigger slice of the computing pie. One big move, the Grace CPU. This is NVIDIA's own processor based on ARM architecture designed to pair with their GPUs. Why is this a big deal? Think about a data center. You usually have an Intel or AMD CPU working alongside GPUs. NVIDIA had no presence in CPUs, meaning Intel/AMD got a cut of the money and controlled part of the platform. Now, NVIDIA says, I'll make my own CPU that works seamlessly with my GPUs. Early tests show their Grace superchip, 2 Grace CPUs together, can compete well in supercomputing tasks, and when coupled with their Hopper GPUs, you get a combo called Grace Hopper with giant shared memory. Great for AI. If NVIDIA's CPU gains adoption, that's a direct threat to Intel's server dominance, and it means NVIDIA could earn maybe 2 times the revenue per system by selling both the CPU and GPU. Looking ahead, NVIDIA might even enter consumer PCs. There's buzz about a project with MediaTek to launch NVIDIA-powered ARM chips for laptops by 2025. Imagine an NVIDIA CPU plus GPU laptop that could challenge Apple's M series or a Windows laptop running on NVIDIA Silicon. Pretty intriguing. Beyond CPUs, NVIDIA's also doing DPUs, smart NICs for networking, and software services like Omniverse for simulation, autonomous driving stacks, etc. They've become a full-stack computing company, from chips to systems to software. This vertical integration can yield big performance gains and lock customers in further. For example, NVIDIA's new supercomputer, DGX GH200, uses Grace CPUs and H100 GPUs in a single shared memory pool. Unique stuff others aren't doing yet. That's attractive to cutting-edge AI labs. Bulls love this because it means more growth avenues. NVIDIA's core business, GPUs, is booming, and these new ventures, CPUs, cloud services, automotive AI, are icing on the cake that could drive the next leg of growth in 2 to 5 years. If even one of these optional bets pays off, say Grace CPU grabbing decent data center share, or NVIDIA wins a chunk of high-end PC CPU market, it could add tens of billions to revenue down the road. It's like NVIDIA's building multiple engines for the growth rocket. Summing up the bull case, NVIDIA is the right company at the right place at the right time. AI is exploding, and they have the tech, ecosystem, and now even government-backed projects fueling them, like that Stargate AI build-out in the USA. They're executing well. 9 of the last 10 quarters they beat estimates, and ROIC is sky high. over 100% in 2025. The bulls see a clear path for NVIDIA to continue dominating and justifying a high valuation. All right, now flip the coin, the bear case. First big risk, geopolitics and the China decoupling. NVIDIA effectively just lost access to the world's second largest economy for its best products. That's not trivial. Before the bans, China accounted for something like 20% of NVIDIA's data center business, and China is racing to develop its own AI capabilities. They're not going to sit idle. We've already seen Huawei rolling out its Ascend AI chips, and companies like Alibaba and Biren designing GPUs. True, they're behind, but being forced off NVIDIA will only accelerate their efforts. Over, say, a 5-year timeline, China could grow decent in-house alternatives, meaning NVIDIA permanently misses out on Chinese AI growth. Also, consider if tensions escalate. Could the U.S. restrict NVIDIA from selling to other countries? They've already added some Middle East regions to license requirements in 2024 because of concerns about diversion. If, hypothetically, there's more conflict, maybe even exports to friendly countries could face more scrutiny. It's a low chance, but a dark cloud. And the supply chain, NVIDIA relies on Taiwan's TSMC to make its chips. Taiwan is a geopolitical hotspot. A worst-case scenario, like a conflict involving Taiwan, would be disastrous for NVIDIA. Even the fear of that risk can weigh on the stock. So bears say NVIDIA's fortunes are tied to geopolitical events out of its control. Right now, U.S. China relations in tech are bad and possibly getting worse. Shorter term, the new export rule, effective May 15th, basically cements that NVIDIA can't sell any high-end AI chips globally without approval. NVIDIA expects 0 licenses for China, so that revenue is gone. So the bear case is that NVIDIA's total TAM is effectively smaller now, and Chinese competitors will rise. Maybe not beating NVIDIA globally, but sufficient for China's needs. The world could split into 2 AI ecosystems, NVIDIA in the West and some combo of Huawei and others in China. That fragmentation isn't great for a unified growth story. Risk 2. Competition is coming. NVIDIA's lead is big, but not unassailable. We know companies like AMD, Intel, Google are pouring resources into catching up. Let's talk AMD. Their upcoming MI300 accelerators have gotten a lot of buzz. Some reports say MI300 could offer good performance, especially in memory-intensive tasks, exactly where NVIDIA's H100 is a bit constrained. If AMD can, say, win some big cloud contracts, for example, if Microsoft or Amazon diversifies to AMD for cost or supply reasons, that chips away at NVIDIA's dominance. It might force NVIDIA to be more competitive on price or to up their game even more. Then, custom silicon. Google TPUs already power Google's internal products like Search and Gmail AI features. If Google offers TPU instances widely on Google Cloud, that's an alternative to NVIDIA for customers, with presumably lower cost since Google designs them. Amazon has its own chips, Trainium and Inferentia, for AWS. Maybe not as powerful, but AWS can bundle them cheaply with cloud services. Over time, other big players might prefer to control their own silicon to avoid being at NVIDIA's mercy. So NVIDIA faces the classic innovator's dilemma. Can it stay far enough ahead that these alternatives don't catch up? Possibly, but competition tends to increase. Also, new architectures. Some startups are doing things differently, like Cerebras with its wafer-sized chip or neuromorphic approaches. If one of those finds a niche, say, a chip that's great at running smaller AI models at low power or something, NVIDIA might not capture that segment. Even on software, yes, CUDA is king, but open source efforts like AMD's ROCm or OneAPI aim to let developers write code that runs on any GPU. If that matures, NVIDIA's moat could shrink. We're not there yet, but think of how Linux and open source eroded some proprietary software in the past. Bears think a similar thing could happen to CUDA in the long run, if enough industry players push for it. In short, bears say NVIDIA's supernormal margins will attract lots of competition, and eventually that competition will succeed in carving out share, leading to slower growth or lower pricing power for NVIDIA. Risk 3. Valuation and the potential for a cyclical downturn. At the end of the day, even great companies can be bad investments if you overpay. NVIDIA is trading around 25 times forward earnings, which for a semiconductor company is very high. It's actually lower than it was a few months ago because earnings estimates jumped, but it's still pricing in a lot of growth. The PEG ratio is about 1.1, which isn't crazy high, but that assumes growth holds up. If growth slows, that PEG could shoot up. Semiconductor history is full of booms and busts. Right now, it's a boom. But what if in 2026, after all the big AI deployments are done, orders cool off? Data center customers might digest capacity for a few quarters. Inventory might build up. NVIDIA has had cycles like that. For example, after the crypto mining GPU craze in 2017, their gaming revenue fell off a cliff in 2018. The stock dropped more than 50% peak to trough. Could something similar happen in AI? Possibly not as dramatic, but it's something to consider. If NVIDIA's growth slows to, say, 15 to 20% in a couple years, will the market still give it a 25 to 30 times multiple? Probably not. It might compress to maybe 18 to 20 times, which is typical for a solid but slower growth tech company. If that happens while earnings plateau, the stock could correct significantly. Some bears are basically saying, great company, but too expensive at this point in the cycle. They might wait for a better entry if, say, a broad market sell-off or an earnings miss knocks NVIDIA down. Also, a quick note on that $5.5 billion write-down. That's a one-time gap hit, but it does indicate that even NVIDIA can misjudge demand or get caught with inventory due to policy changes. So, valuation risk is real. NVIDIA's stock could be volatile. It's not unreasonable to see swings of 20 to 30% in a year. We already saw approximately 25% off the highs when export news hit. Bulls will say it's worth it for the growth, but bears say the margin of safety isn't there at this price. With macro factors like interest rates, a growth stock like NVIDIA could be sensitive. If rates go up, high PE stocks often come down. To summarize the bear view, NVIDIA is an amazing company but facing new headwinds from governments and competitors, and the stock's valuation reflects little room for error. If anything goes less than perfectly, the stock can slide. So where do we land after weighing these factors? NVIDIA's first quarter results confirmed that the AI-fueled growth story is intact, perhaps even stronger than expected. The company delivered about 96 cents in underlying earnings per share once we exclude a one-time export-related charge, and it maintained hefty profit margins. Gross margin would have been over 71% without that charge. Given these robust fundamentals and management's strong outlook, NVIDIA is forecasting roughly $45 billion in revenue for Q2 FY 2026. And we're confident in a 12-month price target of around $150 per share for NVIDIA. That said, there's an important shift now. A few months ago, the stock was trading near $116, well below our fair value estimate, but today's price is much closer to that target. In other words, investors buying at current levels are paying almost full freight, and the margin of safety is much thinner. NVIDIA's valuation now reflects much of the good news and optimism around its AI growth. We still see some upside if the company continues to execute perfectly and AI demand stays red hot, but it's more modest from here. Perhaps single-digit percentage gains, rather than the massive rally we witnessed earlier. In short, we remain bullish on NVIDIA's long-term prospects in AI and data centers, but with the stock now near our fair value estimate, it's time to temper expectations. The company's momentum is extraordinary, but at current valuations, new investors need to recognize that they're buying in at a price that already assumes continued perfection, making the risk-reward profile more balanced than before. Risk management. If you're investing in NVIDIA, size your position according to your risk tolerance. It's a stock that could swing. It's also fairly richly valued, so some investors might prefer to wait for a dip. But historically, dips in NVIDIA have been buying opportunities if the long-term thesis is intact. Upside scenario, if AI spending keeps surprising to the upside, and some analysts think NVIDIA could hit $195 billion revenue in fiscal 2026. Then frankly, a $150 target might prove too low, and the stock could approach $200 in a euphoric scenario or if restrictions ease. Downside scenario, if say global spending slows or a competitor wins a big chunk of business, maybe NVIDIA only grows 20% instead of 50% next year, in which case an $80 to $90 stock is possible as a correction. To wrap up, NVIDIA exemplifies the promise and pitfalls of today's market. It's at the forefront of AI, huge opportunity, yet it's embroiled in global politics and priced for success. The balance of evidence suggests NVIDIA will continue to deliver growth and maintain leadership. Keep an eye on those catalysts we mentioned. And thanks for watching this deep dive. Disclaimer, this video is for education and entertainment only. Nothing here is or should be taken as financial advice. If you enjoyed this breakdown, please like and subscribe. Comment below. Do you think NVIDIA will keep roaring ahead, or are the risks being overlooked? We'd love to hear your take. And drop a ticker in the comments. Tell us who deserves the next deep dive. Thanks for watching, and never stop doing your own deep due diligence.